Everyone is asking which chatbot will win the race, but most investors are completely ignoring a $625 billion problem. You see, artificial intelligence does not run on hype. It runs on steel, silicon, and massive amounts of power. While the mainstream media chases headlines about the next software breakthrough, the world's biggest companies are quietly fighting over a physical bottleneck that is about to make three specific stocks go parabolic. If you have felt frustrated watching the Magnificent Seven skyrocket while you were left on the sidelines, or if you are a professional trying to make sense of the noise, you need to understand that the game has changed. We are shifting from a speculative phase into a period of massive infrastructure scaling and operational value capture. I break down the structural shifts in the global economy using logic, not panic. Today, we are looking at the $55 billion backlog data and the Federal Reserve's rate cut cycle to see where the real money is actually flowing. To understand the future, we have to look at the picks and shovels of the AI era. Most people assume that if you have the fastest chip, you win, but a processor without memory is like a supercar with no fuel line. This is the memory bottleneck that the market is still ignoring. High bandwidth memory, or HBM, is the most sought-after component in the world right now, because it allows for the fast data processing and lower power consumption required by modern AI models. This brings us to Micron technology. Micron has transitioned from a cyclical commodity manufacturer into a primary gatekeeper for the high-performance computing era. Their HBM3E line is roughly 30% more power efficient than their competitors, which is the only metric that matters to a data center owner paying $1 million electric bill. As of early 2026, Micron's HBM supply is entirely sold out through the end of the year. While the stock has seen massive gains, it still trades at a forward valuation far lower than software-heavy names like Palantir, making it a reasonable valuation play for those who understand the structural supercycle we are in. But even if you have the chips and the memory, you still need somewhere to put them. This is where the neocloud revolution is flipping the script. Traditional cloud giants like Always and Google Cloud are jacks of all trades, but AI requires raw horsepower and specialized infrastructure. This has paved the way for companies like Nebius Group and CoreWeave. Nebius is building AI factories from the ground up, designed specifically to handle the thermal and computational demands of large-scale machine learning. They have already secured multi-billion-dollar anchor contracts with Microsoft and Meta, validating their position as a high-growth alternative to the traditional cloud oligopoly. The sheer scale of this build-out is hard to fathom. CoreWeave, for instance, has a customer contract backlog worth over $55 billion, nearly twice as large as it was just a few months ago. This provides unmatched revenue visibility for a company that is still relatively young. These neoclouds are essentially carving out the part of the computing world that legacy hyperscalers were never designed to handle efficiently. For investors, this represents a unique opportunity to get in on the physical backbone of the industry before the capacity catch-up is complete. Now we have to talk about how this hardware turns into actual, high-margin profit. While many AI software companies are struggling with profitability, AppLovin has emerged as a monetization powerhouse. By pivoting from mobile gaming to an AI-driven advertising engine called Axon 2.0, AppLovin has created a money-printing platform with adjusted EBITDA margins of 81%. Their self-learning algorithms match advertiser demand with supply in real time, delivering a return on ad spend that is significantly higher than established rivals like Meta or TikTok. As they expand from gaming into the global e-commerce market, their total addressable market is set to explode. This entire infrastructure wave is receiving a secondary boost from the Federal Reserve. As interest rates fall, the cost to build these massive data centers drops, and the valuation multiples for high-growth tech stocks naturally expand. A rising tide lifts all boats, but the growth-heavy AI scalers are positioned to return twice as much as traditional value stocks in this specific cycle. However, there is a blue ocean question that almost no one is talking about. The energy wall. You can buy all the silicon and memory you want, but if you cannot plug those chips into a stable power grid, the software rarely dies. This is the ultimate bottleneck for 2026. We are seeing a shift where contracted power is becoming a more valuable asset than the chips themselves. The real winners of the next decade won't just be the companies with the best code. They will be the ones who have secured their electricity needs through 2031. This is why companies like Nebius are so focused on securing power capacity well ahead of deployment. The road to 2026 is being paved with industrial logic and by focusing on the infrastructure and the companies solving the hardest physical problems. You are positioning yourself where the real money quietly flows. Do you think the energy wall will be the factor that finally slows down the AI expansion, or will the neocloud providers find a way to engineer around it?